Wow, guys, this is an absolutely amazing video. Krystal Ball appeared on Real Time with Bill Maher, in which Bill Maher actually completely butchers Sagar and Kyle's name. I don't know how you butcher the name Kyle so bad. I think he did it on purpose to kind of crap on new media. I think he's like known as one of the old geezers who hates on new media people. But anyways, they're going to get into a big debate here on inflation, and not only is Bill Maher going to say stupid stuff that's factually incorrect, but the other pompous douchebag is also going to say stuff that's just so ridiculous. And she shuts them down, and I'm really impressed by her knowledge that she explains here and her ability to explain it. I did not expect her to have such a good handle on said information, so go check this out.
Well, I mean, part of this inflationary problem is because we put too much money into the economy. There's way too much government spending, and that's why we have inflation. So that's a large part of that. It's just basic economics.
And that is not basic economics. We had this thing called a pandemic. We had a supply chain crisis. And oh, by the way, there's a war in Ukraine.
It played a role. It's played a role.
So to act like the only reason we have problems now is because people got a little bit of money in their bank account is just not honest.
And a little bit of money, they got more than we spent in World War II. So don't act like
hold on. Hold on.
Don't act like, you said don't act. Don't act like we had to react to the pandemic exactly the way we did. We had to spend $6 trillion.
Okay, but how about the trillions that the Federal Reserve shot at Wall Street? For some reason, people don't get upset about that.
How much did you say?
Fueled the trillions of dollars the Federal Reserve shot at Wall Street to backstop the stock market and the bond market. No one gets upset about that, even though that was a massive
I don't know what
factor in
you're
inflation.
talking about. What do you mean shot at Wall Street?
Well,
when are we talking about?
We're talking about buying assets, buying stocks, buying bonds, buying treasury bills so that they expand the balance sheet. This is during the crisis, the coronavirus crisis. When the stock market crashed, that is what the Fed did. They went into action. They shot
trillions of dollars. But the stock market didn't crash during COVID.
Now it's crashing. It's crashing now.
It crashed, and the Fed came in and backstopped it. That's what happened.
It crashed, and we never heard about it?
No, it crashed. Go back and look at it. It fell off a cliff.
When?
The Treasury bond market stopped functioning, and the Fed took extraordinary action it's never taken in history.
I don't
Somehow
remember
no one
that.
gets upset.
The first week of
Somehow nobody gets upset about the rich people who got tons of money and tons of support, way more than working class people did.
Sure
but
they do.
My God, people were able to feed their kids and they had a little bit of money in their bank accounts. It was the worst thing in the world.
No.
That is one small part of the inflation story, and it is, by the way, not the only thing that we can deal with to get out of this mess.
Well, gas prices.
Biden has
is it a small part, Jimmy?
Gas prices we can largely attribute to an administration that's been waging war on the fossil fuel industry.
That's ridiculous.
And now
they drilled more than everybody. I mean,
that's the talking point.
U.S. production.
No.
Okay, U.S. production is up.
Well,
it will be at record levels next year.
Okay, well,
the fossil fuel companies themselves are flush with cash, but will not invest in new drilling because they would rather give it to their shareholders.
Okay, all right,
That's the truth of what's happening.
Yeah, man. So that was really impressive, her ability to deliver that information. And I was surprised with how much she knew about the Federal Reserve and their operations. But what you saw there was Bill Maher and the other douchebag basically trying to, spit the common narrative about inflation. The first thing I want to jump into is whether or not there was a 2020 stock market crash. There was a stock market crash in 2020. It was actually a global, entire world crash because basically what happens is what's really based on, the economy is investment. And so when people believe that the economy is going to start doing poorly, investment actually completely tanks because they think that their investments aren't going to make any money. So your economy crashes. There's no investments. Businesses can't grow. They don't have money to pay their employees. People start pulling their money out of banks. Deflation happens. You go into a recession, and then if the Federal Reserve doesn't step in to stop a recession, you can go into a depression, which is what happened, back in the Great Depression, right? And we'll talk a little bit about that more in terms of what she had said there. So yes, it is undeniable there was a stock market crash. Maybe the reason why they don't remember it is because the Federal Reserve stepped in as a lender of last resort, and tried to really also, put in a lot of expansionary policies in response to economic recession. You employ expansionary economic monetary policy, whereas in response to like a good economy, you want to contract it, right? When it starts to getting too good. So that's the first thing we have to say. There was absolutely a stock market crash. The fact that it doesn't know that is really, really bad. There was a recession for only 2 months. Now here's the interesting thing, right? What is the definition of a recession? Previously, the definition of a recession was 2 quarters, that being 6 months, of negative GDP growth. So your GDP receding, right? It's going backwards. You know, like your hairline is receding, it's going backwards. The GDP, gross domestic product, which is the combination of all of the product created, you can calculate it in different ways. There's an expenditure formula, a value added approach, income approach. There's a bunch of different ways you can calculate it, but it goes backwards, right? But now it's the NREB, National Relations Economic Board or something. I'm trying to remember exactly what it stands for, but they're now, like, they're a private organization. They're considered to be the authority on recessions. So they said there was a recession for only 1 or 2 months, but they don't follow that 2-quarter thing. They now follow a 20-point different scale. Consumer confidence, unemployment, blah, blah, blah. So much different stuff. So it's not even really clear, but that's what they said. So we did go into recession for 2 months according to them. But really, when it comes to what exactly had happened here in terms of causing inflation, they actually don't even really get into the main thing here. I mean, she brings it up. She brings up the supply chain crisis. She brings that up. But what she says there about the Federal Reserve doing open market operations, the Federal Reserve has multiple ways that it can alter the economy through monetary policy. And so one of the ways it can do it is through open market operations, which is they simply do moves on the open market to, if you want to give more cash to banks to loan out, you want to purchase securities from them. Now, here's a quick breakdown of something that happened in the Great Depression that ended up leading to a new role that was found by the Federal Reserve, right? Federal Reserve, I think, was created in like 1916 under Woodrow Wilson, somewhere around that time before the Great Depression. And it was because of tons of delineated and decentralized banking that was causing a lot of chaos and all this kind of stuff where there would be bank runs. And so the stock market crashed, the economy was in trouble. And what ended up happening was there were a bunch of bank runs. And so people would hear, different stuff about, oh, this bank is going to go under, et cetera, et cetera. Everybody would run to a bank and they would say, give me my money. And so what happens when they don't have the money, right? Typically, I believe banks they have a required reserve ratio that's set by the Fed themselves. Typically, I want to say it's like a 90-10 ratio, but I don't know for sure about that. So if you insert $1,000 into a bank deposit, that $1,000 is a liability for them because they have to give you the money when you ask for them, but they only have to hold like 100. So what happens when everybody who's deposited money into your bank, or enough people where it outruns your liquidity, comes in asking for money? Your bank's going to go under because you have to sell off your securities and your assets quickly, but buyers are not going to want to buy your securities and assets because they know you're in a shitty position, and those securities start to lose their own value as well. And so what the Federal Reserve should have done in that scenario was step in as a lender of last resort, purchase those securities from the banks, and then they could give money to their people who are pulling out their money. And by having enough money to give out, people would stop asking for more money because they would feel safe and, they have the money to give. So this is what they did in the 2007-2008 crisis, something called quantitative easing. Quantitative easing is when there are purchases made by the Federal Reserve from banks for long-term securities. So those mortgage-backed securities that were worth dog shit, that weren't worth anything, what the Federal Reserve did is they bought them at a market rate that was a good rate for them so that the banks were able to stay alive and not go under. Lehman Brothers went under, but after that they started to purchase those securities that were worth nothing, and that made it so that the banks could stay alive, because those assets that were worth nothing, they would have made the bank go under. Not to mention those mortgage-backed securities that were worth nothing, they were bundled into financial instruments called CDOs, where it's like there's corporate debt, there's this kind of debt, there's blah, blah, blah. And so with that MBS going down, all those other financial instruments went dead too, because they were all combined into one. So what the Federal Reserve did in response to the coronavirus situation is... here's what the Brookings Institute says. It says the Federal Reserve stepped in with a broad array of actions to keep credit flowing to limit the economic damage from the pandemic. It's included large purchases of U.S. government and mortgage-backed securities, and then it says lending to support households, employers, financial market participants, and state and local governments. And so what they did was they started buying a ton of these securities, mortgage-backed securities, and other kinds of securities from the banks. That gives them cash to then loan out, keeping lending cheap. Okay, the more money there is in the economy, the lower interest rate is, and vice versa, according to the money market graph. So what we can see is here, though, we haven't even really talked about what the main cause of the inflation itself is. So what we can see here using these economic graphs, just basic supply demand graphs, what happened was during the coronavirus pandemic, what happened was, so what we can see here is a simple supply demand graph. We got goods on the left and services on the right. Now what ended up happening was the demand for goods completely skyrocketed, and honestly I don't even know how far away I want to draw this new demand curve, but the demand curve shifted right because of consumer preference towards goods themselves. And what ended up also happening at the same time was for services, the demand completely tanked. Because how are you going to go on a flight to Italy when there's a global, pandemic going on? You can't, right? So the demand completely tanked. Now, what you can see here, equilibrium point, is the point where the supply and demand curves align. They connect with each other, so there's no shortage or surplus. So now we have our new supply demand. And what you can see with our new equilibrium point, our price skyrocketed. Price is on our y-axis, quantity of goods is on the x-axis. You can see that the price completely skyrocketed, right? You can compare the two price points of our equilibrium points. But then guess what? Now, why did the goods demand go up? It's because during a pandemic, you're stuck at home, and so you need to buy a treadmill or a GPU or a gaming PC or a Nintendo Switch. Whereas when you can go outside, your need for those goods are much lower because you can go outside and do stuff like play basketball. But you can't go on flights to Italy or stuff like that because there's a global pandemic going on. But that's not it. So what also ended up happening was the supply chain also completely collapsed. And so you have your supply curve shifting left because of new coronavirus regulations. And so now you have a new equilibrium point here between our demand 1 and supply 1, right? This is our new equilibrium. We're going to call it EQ2. And so what you can see with the price point is it went up even higher. So it went all the way up from our original equilibrium point down here all the way up here, right? Look at how much that just went up. Whereas you can see with the services, right when coronavirus hit, like airfares completely tanked in prices because nobody wanted them. Demand tanked. And so what happens with the price we see from the equilibrium points between the original to the second one immediately in the aftermath of coronavirus, you can see that the price completely tanked, and that's what we saw. Now, the supply ended up contracting later on because of there were less people who are going to have the demand for airfares. Obviously, they're going to start providing less. So, that ends up giving you a new, equilibrium number. But, that ended up happening later. This is the main thing. And so even now, like when I went to Target the other day, I went into the sports section, and I haven't seen an aisle that stripped away of stuff in a long time. So now what the Federal Reserve is doing is they're trying to taper demand. Now, in terms of aggregate demand, like AD, what you have to do in a situation where you have a recession going on is you need to really stimulate the economy for it to be able to survive. So, in terms of looking at this from the from the aggregate demand, right? Aggregate demand is, is your total demand for all goods combined. So, you have output level GDP on your x-axis, you have price on your y-axis, and so this is our equilibrium point. Your long run supply curve is actually going to be straight, but your SRAS curve is short run supply curve. Aggregate supply curve is going to be upwards, continuing. And so what ends up happening in a recession is when everything shuts down, your aggregate demand curve completely tanks. And the issue with your aggregate demand curve completely tanking is your price goes down, but it's not going down in a good way. Deflation is actually worse than inflation because you can, with interest rates, you can only, you can't move your interest rate below zero. So it makes it really difficult to get out of deflation. This is what happened in the Great Depression. And so that kind of deflation is what you want to avoid, because what ends up happening is people demand less goods, they spend less money at businesses, businesses have less money, no one wants to invest their money because the economy sucks buns, and then everything collapses. And so what you need to do is you need to shift the aggregate demand curve right, and how you can do that is stimulate the economy by giving more money to people. So you give them cash and then aggregate demand curve shifts right. Businesses are able to sell goods. They're able to hire workers, etc., etc. So the issue now is with the supply curve being the problem, because it still seems like the supply curve is the big issue. Now, how much is the demand overstimulated right now? I don't know the answer to that question. It's a good question, but I don't know how overstimulated it is. And so what is the Federal Reserve doing now? Well, the Federal Reserve is now upping its federal funds target rate for the interest rate, right? They don't directly set the interest rate except for the discount window, which is the rate at which banks can go to the Federal Reserve. Bank of America can go to the Federal Reserve and be like, hey, I want to take out a loan. And that's the interest rate that they set in the discount window. But when you hear in the news, it's what they're really doing is they're setting a target rate for overnight exchange rates on reserve numbers, I believe it is, and then the Federal Reserve controls like interest on the reserve rates and blah blah, and then they use that as a floor, and then they use the discount rate in the discount window as a ceiling to basically control it, to try to alter it. So now that's what they're doing, but it's kind of like, if the issue is supply and not demand, how is raising the interest rates really going to fix the problem? Doing that might actually make it worse, because raising interest rates means people want to invest less. Now, this was an article just March 28, 2022. It's just a couple months ago. It says the supply chain crisis is about to get a lot worse. And it says, seemingly endless supply chain crunch has fueled interest in tech that promises to track problems or predict where new ones might occur. Supply chains in chaos and it's getting worse. Air freight warehouses at Shanghai Pudong Airport are log jammed as a result of strict COVID testing protocols posed on China's biggest city following a local outbreak. City's port Shanghai Ningbo, more than 120 container vessels are stuck on hold. In Shenzhen, a major manufacturing hub in the country's south, trucking costs have shot up 300%. 300% due to a backlog of orders and a shortage of drivers following the introduction of COVID restrictions. Major ports the world over, which used to operate like clockwork, are now beset by delays, with container ships queuing for days and some of the worst congestion ever recorded. List goes on. And then it goes to talk about how the supply chain is having even more issues because of the Russia-Ukraine war. And so it's like, basically says that the supply chain is just so interconnected. And I guess this would be one of the arguments against free trade and having our trade very international based, because if you understand like basic economics, that you have benefits from you can increase your output levels, your total output, by doing global trade and specialization based on what a country is good at. So if a country is really good at wine, another country that's really shitty at producing wine, it would be an economic waste for them to try to, it'd be like Italy trying to produce oil instead of trading with a country like, some Middle Eastern country. It'd be a waste for them, and it lowers your production possibilities. But then you have this issue too, where it's like, oh shit, like if there's a war that breaks out, or if you have a coronavirus pandemic, now your whole thing is going under, right? So how are you, all this Fed response that I'm seeing right now with, we're going to up interest rates, that's all trying to taper demand. But what if the problem is mostly the supply chain, which is what I personally think it is? Then there's also, as you can see in that video where Krystal Ball is talking about, the other douchebag is like, oh, Joe Biden has really, he's declared war against the oil industry. That's the reason for oil prices. Are you serious? The big reason for the oil prices going up is the Russia-Ukraine war. But the fact that he said that, and Krystal Ball is like, no, like it's going up. Production is going up. They're getting more licenses to drill, but they're not drilling because the prices are higher per barrel. And so it's not necessarily beneficial for them to increase the supply, because what happens to the equilibrium price when you increase supply? It goes down, right? If you have your supply demand and you only increase your supply curve, the equilibrium price for oil will go down. They don't want prices to go down. They want it to stay high. So they're not going to do that. Also, corporate price gouging is another thing for sure. And really the big reason why we're seeing this is something I've been talking about for a while, is actually corporate consolidation. And so what really determines the prices, right? The prices are determined by competition. But what happens when there's no competition and all the corporations and industries, there's like maybe 2, 3, 4 max like firms in an industry, like Samsung and Apple make up like 80 or 90% of the phone industry. Think about that, bro. It's like something like that. I think Apple's like 50 something and then Samsung is like 30. That's fucking insane, dude. Our phone industry is a massive, massive oligopoly. We have free market capitalism, my ass cheeks. Anyways, so what happens when everyone's consolidated? They get to control their prices. Like, how many of you guys actually know what a cartel is? Like, what is a cartel? You know, it's not just some criminal organization. A cartel is a group that openly fixes prices. What's a great example of that? OPEC. I think OPEC is like it's like the oil and petroleum exporting countries, I think is what it stands for. That's a cartel. It's a grouping of a bunch of Middle Eastern countries and Venezuela oil producing companies who come together and say, we are going to fix prices. We're going to determine it. We're not going to compete against each other with market forces. We're going to openly come together and say, we're going to fix prices. A lot of people are saying that's what oil companies are doing right now too. So, you know, when you have all these, have all this little, corporate, you have little competition, businesses can just set whatever prices they want. And so if you're saying, oh, like, why didn't they raise the prices before? It's because now is a good opportunity because of already inflation existing, combined with the fact that they have less competition, so there's not as much pressure. Because hypothetically, if you have like a couple of businesses in an industry, you could just come together and say, we're going to set the price at this number, and that's just the price, and it's not going to move. That's price fixing. That's illegal. I think according to the Supreme Court, that's straight up illegal. But, you know, when you don't have really much competition, how are you going to bring the prices down? And so, you know, they're not, you know, they're just giving money back to their their shareholders, as Krystal Ball here explains. A really, really good showing from Krystal Ball. I was impressed with her knowledge on the Federal Reserve and open market money operations, and how, you know, they control the money supply. You know, one of the big ones that they do, probably the biggest one, is open market operations. And so, you know, they play a role of a lender of last resort when banks are starting to go under, to save the economy, because the economy is so dependent upon banks as the intermediary for loans and stimulation, etc. They'll come in and they'll purchase treasuries and securities, specifically securities and bonds, right, to give them money, to give the banks cash, because you want to keep investment cheap and you want to make sure that cash is flowing throughout the economy. So they'll go to Bank of America, the Fed will go to Bank of America, and you'll be like, all right, here, I'll cop your mortgage-backed securities. Now, typically you're supposed to purchase short-term securities, so maybe like a couple years. I don't know if it'd be like 3-5 years, but I think that, I don't know how long typically mortgage-backed securities last. If you don't know what a mortgage-backed security is, it's just a shit ton of mortgages combined into one financial instrument. And so you can sell that as an asset. So instead of it being boring, like, oh, here's a AAA rated mortgage to sell to someone, you go, hey, here's 1,000 mortgages, 95% of them are AAA rated, 2% is rated BBB, and 3% is rated B. And those are called tranches, right? It means slice in French. And so you can actually even sell like tranches of it to somebody if you want, if there's like a low risk investor who's like, no, I want low risk investment. They're not going to make as much money, but the risk is way lower in a crash, right? In a default sense. So you may buy up like a certain amount, 50 million of, triple A tranche. But if you're like, well, I want a high risk investment, you go, all right, dog, I'll take 50 million of, single B tranche. That's super risky, right? Super, but you get a lot of payout. So, that's the risk that you take. But, so they purchase it. But quantitative easing is when the Federal Reserve purchases more long-term assets. But I don't know what they determine as long-term. If mortgage-backed securities last like 10 years, 7 years, 10 years, 20 years, 30 years. I mean, obviously mortgage fixed rates are usually like 25, 30, 35, 40 in the very long term. But I don't know specifically how long those assets for like the mortgage-backed security itself last. I don't know if it's the same amount as the fixed mortgage rate typically or not, but more research is to be done in that area. Obviously, I will get to that and do more reading. But hopefully you made it through the end of this video. Type gains if you made it through this entire video. If you made it through this entire video, you a goat. I'm not even gonna cap. There was so much information here, but shout out Krystal Ball going off and destroying Bill Maher and this other idiot. Oh, the reason oil prices are going up is because Biden has declared war on the oil industry. Like, no, it's because of price fixing and corporate gouging and the Russia-Ukraine war. It's like, no, that's not the reason why. Not even close. There's more drilling, there's more drilling permits being given out, and they don't want to increase the supply of oil, because if they increase the supply of oil, the equilibrium price of oil goes down. They want a high equilibrium price of oil, not a low one. Anyways, that's what's going on. Shout out Krystal Ball. Eins mehr.